Hey there everybody, this is Randy with Home and Land Realty, back with another tip and advice video for you. Today I want to talk about all the different types of home loans that you might run into if you were to go get pre-approved for a home loan. To begin with, there are two basic types of mortgages that you'll be looking at. Most likely you'll be looking at a fixed rate mortgage. That's where your percentage rate is fixed for the life of the loan. That is what most people get these days. And they can range anywhere from a 10-year mortgage to a 50-year mortgage so your payments are spread out over that many years. The most typical is a 30-year mortgage. So what you'll hear a lot of people talk about is a 30-year fixed rate mortgage. So the other type of mortgage is an adjustable rate mortgage. And just like it sounds, the rate's going to adjust on you. Now, it's going to be locked for a few years. So typically you'll see a 3-year or a 5-year. So they'll call it a 3-1 or a 5-1 or sometimes a 7-1 even, adjustable rate mortgage. That means that your initial rate is locked for the first 3 years, 5 years, or 7 years. And it's generally a lower interest rate, quite a bit lower interest rate up front. So maybe as much as 2 or 3 points lower than the typical interest rate right now. And then the one part, so it's a 3-1, 5-1, 7-1. The one means that after that initial 3, 5, 7 year period, that your rate can adjust up to 1% every year. So if the rate environment is going up during that time, then at the end of that third or fourth, fifth year, whatever, every year thereafter, it can adjust up to 1% per year. Fixed rate are better for people who plan to be in their house for a long time. If you plan to be in your house for more than 3 years, you should get a fixed rate mortgage. If you plan to move in a year or two, or maybe less than 3 years, you know that you're going to be leaving the area, or you know you're going to be selling and moving for some reason, then adjustable rate mortgage might be a very good idea for you. A lot of places do not do adjustable rate mortgages, so you need to shop around. Most of the time it's going to be a local bank or maybe a credit union. A lot of the mortgage companies that are mortgage specific that don't do banking, they oftentimes do not do adjustable rate mortgages. Okay, so that's the two basic types. Now we're going to get into the different loan programs that you might look into. So the most typical loan program is conventional. Typically a conventional loan, you'll hear people say that you need 20% down for a conventional loan. That is true in that for a conventional loan, typically a 20% down will help you avoid mortgage insurance. You can do a lower down payment on conventional loans as low as 3%. So a conventional loan, if you're a first-time home buyer, you can do a conventional loan at 3% down. If you're not a first-time home buyer, you can still do a conventional loan at 5% down. You can also do 10%, 15%. But once you get to 20% down, the mortgage insurance goes away. So if you put less than 20% down, you're going to have what's called mortgage insurance on the loan, which just increases your monthly cost a little bit. Typically, a conventional loan is for slightly better credit borrowers. So you have to have typically like a 620 credit score or higher, and they want to see your debt to income ratio generally less than 50%. So all of your loans, including your new home loan, they don't want to see you have more than 50% of your income going to debt. Say you don't have quite that good credit score, or maybe you do have a little bit higher debt. The next most typical type of loan is called FHA loan. That's Federal Housing Administration loan. That's a government-backed loan. Very typical. A lot of people do FHA loans, and it's a pretty good loan. Interest rates are pretty competitive to conventional loans, and it's a 3.5% down. And to get that 3.5% down, you don't have to be a first-time home buyer. That can be anybody that qualifies for an FHA loan can get it for 3.5% down. And then it goes down to typically a 580 credit score or higher can get a FHA loan. There are banks that can even go lower than that. Your interest rate is going to be higher, but shop around that if you have a lower than 580 credit score. If you do have a lower than 580 credit score, then go back to my last week's video of how to increase your credit score. So I'll link that up above so that you can go back and see how to improve your credit score. So not only will they go little lower credit score on an FHA loan, but you also can have a little bit higher debt to income ratio, maybe a little over 50% of your debt they will allow, of your income they will allow to go to debt. So they're a little easier to qualify. The big problem with FHA loans, though, is there's mortgage insurance on it that never goes away. So on the conventional loan I was talking about, mortgage insurance, you can remove the mortgage insurance once you get to around 20% equity in your house. So once you've paid your loan down and your house is increased in value enough, you can have that mortgage insurance removed. FHA loans, the mortgage insurance never goes away, so you always have that little extra fee on your monthly payment. So some specialty loans. If you are a veteran, you can qualify for a VA loan. So if you're a veteran, you already know this. I'm sure they've told you this. So, but just for general information, a VA loan or veterans loan is 0% down. There is a funding fee up front, or you can finance it in. If you are a disabled vet, the funding fee can be removed. If it's your first time using your VA benefits, the funding fee is a little lower. It goes up every time you use the VA loan. The funding fee goes up a little bit. It can be paid as a closing cost, or it can be added to your loan amount. Not only no down payment, but you can add it to the loan amount, so you can actually get into a house on a VA loan with very little money out of your pocket, which is a great benefit for somebody that qualifies for the veterans loan. They also have very liberal qualifying guidelines, lower credit scores, higher debt to income ratios, all those types of things. They're very liberal, and they work really hard to get veterans home loans. So another one is USDA. USDA is specifically for rural areas outside of the larger cities. It can be in the country, or it can be in small towns outside the city. And really, you just need to, if you have a town or an area in mind, you should just have a realtor or a lender look up or you can even do it yourself. On the USDA website, you can type in the address and look and see if that area qualifies for USDA financing. It also is no down payment, 0% down. It does come with a mortgage insurance aspect, but it's lower than FHA. It's not quite as expensive. Probably the only caveat that's really kind of a sticky point on USDA is it is for somewhat lower income folks. There are income limits. If you make above a certain amount, you cannot get a USDA loan. Typically, a family of 1 to 4, the current in 2025 in most parts of the country, it's an income of $112,000. So if you make more than $112,000 in a family of 1 to 4, $112,000 more than that, you cannot qualify for USDA. And they take into account every working adult that lives in the house. So married couples, husband and wife, and any 18 years old or older person that lives in the house that makes an income, all those incomes have to be taken into account when qualifying for a USDA loan. If you're looking at a higher price home above $800,000, $806,000 actually, then you would be looking at a jumbo loan that requires a little higher credit score, the debt to income requirements are a little stiffer, the interest rate's a little higher. That's just, if you're looking at that type of higher price house, you should shop that around and talk to some different banks for the best jumbo rates you can find. Apart from that, there are some other specialty loans you might look into, especially if you're a first-time home buyer. In Missouri, which we're in Kansas, I'm in Kansas City, so I'm going to talk specifically about the Kansas City area, which is Kansas and Missouri. So in Missouri, there's the Missouri Housing Development Commission. They have a down payment assistance program that can loan you basically the down payment for your house to go with a FHA loan generally. So the 3.5% down payment can be loaned to you that you don't have to pay it back as long as you live in the house for a certain number of years. So once you've lived in the house for 10 years, then you don't have to pay it back at all. Between 5 and 10, you have to pay a portion of it back. If you sell before 5 years, I believe, then you have to pay the whole thing back at closing. And that's for first-time home buyers, people who have never owned a home, or I think it's if you just have not owned a home in at least the most recent 3 years. In Kansas, it's called the Kansas Housing Resource Corporation, and it's similar to MHDC. Slightly different rules, that type of thing, but it's down payment assistance. You do have to live in the house for a certain number of years to not have to pay it back. But they're a little more specific in some areas that they don't do it. So like in Kansas City, Johnson County, and Kansas City, Kansas, they do not do the KHRC program. They have their own programs in those cities. So you should check local municipalities if they have specific programs for those municipalities. Apart from that, certain professions have special loan programs. So if you are a doctor, you probably already know this because you've probably been told this through your schooling, that there are programs for doctors basically that help you have lower payments when you first get out of doctor school, when you're not making quite as much money as you're going to make eventually. So it's a little easier monthly payments on those for a few years. Nurses, teachers, policemen, firemen, there are a lot of programs for those as well. But whatever your profession is, look into it. There might be a program for you. So anyway, if you have any further questions, please reach out. I can help you, or I have loan professionals that can answer your questions about qualifying or the ins and outs of any of these mortgage programs. I hope this helps. Thanks for watching today, and I hope you have a great day. Bye-bye.